So what if I told you the secret to successful long-term investing wasn't about frantically searching for the next big thing, but about, well, ignoring almost everything? In this explainer, we're going to break down a really simple but powerful and, yeah, sometimes pretty radical investment philosophy. It challenges so much of what we're taught about building wealth. So let's dive right in and see what this is all about.
All right, here's what we've got on tap. First, we're going to cover the core philosophy, this whole idea of winning by just tuning out the noise. Then we'll get into the specifics of the investment they recommend, QQQ, and we're going to bust a huge myth about it. After that, we'll talk practicals with a super simple 2.5% retirement rule, tackle the, let's just say, controversial take on the real estate trap, and then we'll pull it all together to show you the complete path to wealth. Sound good? Let's go.
Okay, so let's get into the foundation of this whole thing. The entire strategy, really, is built on a mindset that just runs completely opposite to what you see on the 24/7 financial news channels. It's all about, radical focus. I mean, just let that sink in for a second. The message here is crystal clear. You have to completely detach from all the noise. The daily market swings, the international drama, the endless parade of experts on TV. This philosophy says, for a long-term investor, none of it matters. It is a truly stoic and almost defiant way to look at the market. So, okay, how does this actually translate into what you do? Well, it's about as straightforward as it gets. Step 1, when you have cash available, you buy. Simple as that. You don't try to time the market, you don't wait for the perfect dip, you just buy. Step 2, you hold. And when I say hold, I mean indefinitely. The plan is not to sell when things get a little scary, or even when you've hit some arbitrary profit number. And finally, step 3, you tune everything else out. Seriously, no obsessing over earnings reports, no listening to economic forecasts. It's just a simple, super disciplined process.
All right, so if the entire strategy is just buy and hold, the obvious next question is, buy and hold what? The investment vehicle at the center of this playbook is the QQQ ETF. Now, that tracks the Nasdaq-100, and right away that brings up one of the biggest misconceptions we absolutely have to clear up.
You know how it is, right? A lot of people hear Nasdaq, and their mind immediately jumps to tech bubble or super risky tech stocks. The assumption is that if you put your money in QQQ, you're just making a huge concentrated bet on a single industry. But is that what's really going on here?
Okay, so this really lays it out. On one side, you have the myth that QQQ is just a tech sector fund. But the reality is completely different. QQQ has one and only one rule. It includes the 100 largest and most powerful non-financial companies listed on the Nasdaq. That's it. The only thing that matters is strength, not what industry they're in. And hey, the proof is right there in what it holds. Sure, you've got your Apples and Microsofts, but you've also got giants like Costco and Starbucks in there. And why is that? It's because they're simply among the strongest companies on the exchange. The index has no personality, no bias. It's just a pure, clean reflection of who's leading the market at any given time.
This actually gets at a really powerful idea. Think about it. What we call high tech is constantly changing, right? 100+ years ago, trains were the absolute peak of technology. 40 years ago, it was a color TV. The whole point is that the strongest, most innovative companies are always evolving. And QQQ is built to automatically capture the leaders of whatever era we're in, whether they're building railroads or, artificial intelligence.
Okay, so we know what to buy and we know the mindset to have. But what about the end game? How do you actually live off this stuff when you retire? Well, that brings us to a surprisingly simple rule for managing your money when you stop working.
All right, the single most important number in this whole retirement plan is 2.5%. That's it. This one little number is the threshold that guides your entire withdrawal strategy. And it's all designed to make sure your nest egg can last for the long haul, because it's all about preserving your capital.
And here's how you use it. It's super practical. You just ask yourself one question. Are my yearly living expenses 2.5% or less of my total portfolio? If the answer is yes, then hey, a standard QQQ portfolio is all you need. You're good to go. But if you need to pull out more than that 2.5%, the strategy is to add some high dividend funds to the mix, something like QQQI. The whole idea is that those funds kick off extra cash, so you don't have to sell off your core holdings.
All right, now we're getting to what might be the most controversial part of this entire philosophy, and that's the argument against owning a home as your main way to build wealth.
I mean, for most of us, this is the goal, right? It's what we're all taught to strive for. Owning your own home is seen as, the cornerstone of the American dream, a symbol that you've made it.
But this philosophy, it presents a totally different picture. It argues that for a lot of people, that dream home is actually a financial trap. It's something that just eats up your capital and actually holds you back from building real, lasting wealth. And this quote, man, it really gets to the heart of the argument. The idea is that when you've got a huge mortgage, plus property taxes, plus insurance, your money isn't really working for you anymore. It's just flowing straight to the banks and the insurance companies. You basically become an employee of your own house instead of having your assets work for you. And the opportunity costs, I mean, just think of all that money that could have been in the market growing for you instead. It's just massive.
Okay, so let's pull all these different pieces together now. We've talked about the mindset, the investment to use, the retirement rule, and the big trap to avoid. Let's wrap it all up into a final playbook.
When you get right down to it, it's all about 5 key principles. Number 1, ignore the noise and the predictions. Number 2, invest in the strongest companies using QQQ, not just a random sector. 3, use that 2.5% rule to guide you in retirement. 4, watch out for that real estate trap that can lock up all your capital. And finally, the simplest rule of all, buy when you've got the money and then just hold on for the long term.
And that really leaves us with one final and I think really powerful question for you to think about. When you look at your own financial life, your investments, your home, all of it, ask yourself, are your assets working for you or are you working for them? It's a question that really gets to the absolute core of this entire way of thinking about wealth.